Welcome to this edition of Models to ACE. Presenting an Excel spreadsheet-based model to enable a day trader to simulate a sequence of trades, their chance-driven outcomes, and derive expected individual and aggregate outcomes to guide his trading decisions. Using simulation, a day trader executes a sequence of trades repeatedly on a particular day of the week. He starts the day with an opening cash position of $99 million. If he bets in the wrong direction, he loses $1 million in a trade. On this particular day, his trading strategy comes with a 63% chance of ending in a loss. The chance of him neither losing nor gaining in a trade is negligible and can be assumed to be impossible, for all practical purposes. Thus, there are only two possible outcomes for trades on this particular day, either a loss or a gain. The trader does not mind placing bets one after the other as long as he is making gains on every trade. He, however, stops trading for the day if either he encounters 5 consecutive losses or if the number of losses exceeds the number of gains by 6, at any given point of time. Let us examine the spreadsheet model, in this tab titled Trade Sequence Model. For a primer on simulation, please refer to the simulation videos under the playlist on Project Management, on this channel. This table summarizes the micro factors impacting the target metrics, that is, number of trades and final net cash balance. These are the independent variables that will act as inputs to our model. This table titled Trade Outcomes and Sojourn contains our simulation model, where we simulate 999 trades. Each row of this table represents a trade, its chance-driven outcome, and the aggregation of such outcomes from the first trade through the current one. For example, in this first row representing a simulation of the very first trade of the day, this is a random chance value obtained by using Excel's random number function rand, which picks random numbers off a uniform distribution between 0 on the lower bound and 1 on the upper bound. The probability of a loss-making trade is 63%. So, if this random number happens to lie between 0 and 0.63, the trade is marked to be a loss-making trade. Otherwise, it is a trade that resulted in an MTM gain. These two columns maintain a running count of gains and losses encountered thus far. The last column represents the decision variable for the trader: should he continue trading or fold for the day. This end condition checks if the preceding 4 trades as well as the current trade have resulted in consecutive losses. Recall that this was one of the exit conditions for the trader. This condition checks if the number of cumulative losses till the current trades exceeds the corresponding number for gains by 6. If either of these two conditions is met, the cell is filled with the text fold, and all subsequent cells in this column are marked as not applicable, since the sequence of trades gets terminated with the row containing fold. Having modeled the first trade, we can replicate these for the remaining of the 998 trades, simply by selecting the first row and either manually dragging it over the remaining 998 rows, or automating the drag operation by double-clicking on this bottom right-hand corner of the selection. For the latter method to work, we must have non-blank values in this preceding first column, occupying as many contiguous rows as the number of replications we want. This column is obscured from view by setting the font color to the same as the cell background color. It is further obscured by reducing the column width. Having simulated trades, we capture the total number of trades executed by the trader in this cell and the consequent cash balance in this cell. This table is thus an output of our simulation model. For convenient usage in formulae and intuitive understanding, we assign names to these values and ranges using Excel's Name Manager. Let us launch Name Manager and examine these. In this second tab, titled Expected Outcomes, we run our simulation model 98 times to obtain 98 pairs of values for number of trades and final cash balance. We then plot these on graphs and observe trend behaviors to base trading decisions. The values are tabulated in this range of cells. Along this column, we list out the values of the number of trades. Under this column, we point this cell to the value of number of trades, produced by the simulation model, in the previous tab. In the next cell, we point to the corresponding value of final cash balance. Instead of manually repeating this 98 times, we will use Excel's data table to automate the generation of this table. Selecting this range of cells, we launch data table from the What If Analysis section. Since each iteration requires no input values for the model, we set the column input cell to a dummy value and instruct data table to auto-generate output values. This table plots the expected final EOD cash balance against the number of trades till fold, along with this trend line, using data in these two columns of the generated table. This table gives a valuable insight on the marginal value contributed to the net cash balance by each additional trade. This can be determined by the slope of this graph. These two cells capture the average of the values in this range of cells. Thank you for giving Models to ACE the opportunity to serve you with our analytical models. Please subscribe to our channel for more.